and inheritance, and additionally the distribution. So let's go back to the same cycle of life, because remember we had mentioned that the top part of this circle is where most people are extremely vulnerable. So this is when someone is a child between the age of 0 to their early 20s, and now past the age of 60, 65, when you no longer are working or getting an income. So from the eyes of the retiree, you have to ask yourself, what happens if I was to outlive my savings? Yeah. What happens if I was to fall sick or I did not, secure an estate plan, right? So what are the 5 consequences of retiring without a plan? Yeah, and first of all, there's financial instability, because now if you do not have a plan, it means you do not have a place where now you're going to be able to get money to be able to pay your bills. It will not be able to pay for, things just like even simple things like food, clothes, even shelter if you didn't have a home. That means that you will definitely, have to depend on somebody else. So you will not know whether today you have or tomorrow you don't have, right? So if there's one thing I say is retirement can be such an equalizer, right? You were so used to maybe a certain level of income, but because of lack of planning, all the income now just stops and you didn't have any savings. So what happens? Yeah, financial stability, there's inadequate healthcare because, you don't have money. So how are you going to afford medical? Yeah, increased stress and anxiety. When you don't have money, it is such a heavy mental load, right? Reduced quality of life. You're used to a certain lifestyle, but because you didn't save up for your retirement, then it means that the lifestyle that you're used to stops, right? And then dependence on others for financial support. So even the main theme of this whole conversation is for us not to be dependent on our children or people who are now coming after us. And if we don't plan for retirement, then this is definitely what is going to happen. So now we're going to talk quickly about now the pension plan. So this is a fund that provides a monthly payment to its members, aiming to replace lost income at retirement, because most probably at that time, you've stopped working, but you still have needs, right? So you need to ensure that there's an amount of money that is paid out to you every month until whenever you're not there. Yeah. So it's good to now budget for retirement, and it involves, outlining the money it is that you expect to have, the bills and necessities that you need, and, obviously putting things in priority. And budgeting for retirement requires that you determine how much you should be saving to meet your retirement goals. So in the case of you need any help, we can guide you in this, because it involves quite a number of factors, because the goal we need to anticipate what will be the annual expenses, in retirement, any significant purchase like a house, or for people who have children later in life, we need to put that into consideration, because we have had situations where we found our clients who wanted to retire, but there's this client of ours who got a child at the age of 50. So see there, the budgeting changes, because now you are not planning to pay school fees, but now because this child came in, you have to make a plan. Then the amount of money you'll spend at that time will determine the amount you need to save every year. So we just literally have to work backwards. We just need to be able to project. And the beauty about it is now we keep on checking in every year to just see if you're at par, right? So a well-planned budget includes the asset that will fund the retirement. So how are you going to be getting an income? So you need a guaranteed income, which is where the pension comes in. And then there's essential expenses like food, discretionary expenses like travel and hobby. Depends, again, on how you choose to retire. People retire differently. Some want to, do some charity work. Others want to teach. Others want to just travel, right? Or some just want to stay at the house and rest. It's just literally up to you. So the factors to consider is the estimate you'll spend every month or every year. And again, it's important to consider the income you have. So you write down all the sources of income. So that's obviously, if you have sources of income by that time of retirement, say you already have a bond and you're approaching retirement, most probably the amount of money you might need to save towards the pension is not that much. Yeah. And then you need to establish a savings pattern that will accommodate this changing lifestyle. So this is an example of, in the case you wanted to retire with 300,000 a month, how much exactly is that you have to contribute every single month. So for you to be able to get 300,000 a month, you have to have accumulated about 38 million shillings in lump sum, right? So that means if you are starting to contribute now at the age of 25, all you need to do is contribute 8,156 every month to be able to retire with 300,000 a month at age 65. And you can see at the age of 50, for the exact same amount of money that you need to retire with, the 300,000, you have to put in more money because the time period is shorter to your retirement. You see, between the age of 50 to 65, that's 15 years. So it means you have to aggressively start putting money aside to be able to retire comfortably. This is why it's best to start retirement planning as early as possible. This retirement will come, and when it comes and you've not planned, it's going to be so hectic. We work with clients every day who are now in their late 40s, early 50s, and they don't even know where to start because they've not put any money aside. And now retirement is slowly approaching. They can already see that now they're going to continue that cycle, right? That they've been trying to work so hard against, right? So you can see now, depending on the age you start contributing, it will determine the amount of money you contribute every month to still reach the same goal of 300,000. So this was just an example of now someone who might need, if they were to project, they need about 300,000 at that time to be able to, take care of their expenses. Because you see, it will depend. Maybe at that time you already have, depending on how you've planned yourself, maybe you already have a home, you don't have to pay rent. Maybe this money is mostly needed for utilities and to take care maybe of your medical expenses, right? So what if now you are actually approaching retirement, or you retired, or you have a parent who's retired and they have a lump sum? So this first part was if you're contributing every month, like right now, our age, we're putting money aside every month to be able to retire well. But what happens if we have a parent right now, or even if it was us who have a lump sum, right? So what happens to be able to ensure that you are receiving an amount of money for life? That means that there's two tools that you can use. One is an annuity and one is an income drawdown. And I'm going to describe them right now so you can understand what is the difference. And you see where it is, say, you can put your parents, because there's people who choose the different ones for different reasons, right? So number one, we have the annuity. So an annuity is sold by an insurance company. So when you buy an annuity today, what that means is the insurance company is promising you that it will give you a monthly income of, say, 300,000 or 100,000 every single month until the day that you die, right? So the thing is that when it comes to annuities, there's limited control because the funds are managed by the annuity provider. So it means if you put money, like I put in all my lump sum right now into an annuity, and the insurer or the annuity provider has promised me 300,000 a month, I cannot pull out, say, in year 5. Say in year 5, I need 1 million. I cannot remove that money from anywhere. That's why it's good to have this plan and maybe other investments on the side in the case now you need some level of liquidity, because all the money you've put in an annuity, just like a life insurance, you just can't pull it out at any time that you feel like, because the insurer said you put your money, the lump sum here now, and even if you live till 150, you're going to get 300,000 shillings, right? That's what an annuity does. An income drawdown on the other side is a bit more flexible, because now this one is now being put in an investment. That means that you can still be receiving the 300,000, but if it reaches a point that maybe you need a bit more money, it's a bit more flexible. You can be able to remove the cash. But the only problem is if you are to do that, it means that obviously maybe for the subsequent month, you might not be able to receive the amount of money you had expected, because you're withdrawn from the capital. When the capital obviously is less, the interest is less, because what you're essentially getting from the income drawdown is the interest. Just say, for example, like a money market, how it is that it works, right? You put money in a money market, say we had put 10 million shillings, and every month you're receiving 100,000 shillings, right? If you're to remove 1 million shillings from that 10 million, you'll be left with 9 million. The amount of money you're receiving is no longer going to be 100,000, to be maybe like 80, yeah? Because you've touched now the capital. So you see, with income drawdown, again, because it's an investment, you're not really assured of the return, right? It might be 100,000. You see, it will be dependent, yeah, on how the market is and what is the risk profile you've taken on this income drawdown, right? Flexibility of income, it's both of them are fixed regular income so you see now for annuity, it's fixed for a set period of time. or for life, right? Depending on which annuity you pick. And then income drawdown, it's fixed income withdrawals, allowing adjustment based on needs. That's why I said this one is a bit more flexible for people who do not want things to be set in stone. And then investment risk. So annuity, it's low risk because it's the provider who assumes the investment risk. That means that if the markets are going down, yeah, the insurer or the annuity provider still, if they promised you 300,000, they have to give you 300,000, whether they are making money or not, because they are the ones who have assumed the risk. But you see, for an income drawdown, yeah, it's dependent on the market, because you as an individual are assuming the risk. So if the markets do badly, you'll do badly. If the markets are doing well, you'll do well. So it can be a pro and a con at the same time for both of them. And then access to funds, so limited access to lump sums once annuity is purchased. You see now you're going to, if you are trying to withdraw the money, most probably you're going to get penalized for it, or you might not even be able to get it at all, yeah, because it's fixed, right? Just think about it like a life cover, but this one, though, is now meant to protect you against outliving your income. So whatever it is that the insurer has said, you've put in your lump sum here, your insurance said, or the provider said, I'm going to give you this amount every month, that's what you're going to get. And then with the income drawdown, greater access to funds with the ability to withdraw lump sums. So there's the flexibility, right? Longevity risk. So here, the provider, they bear the longevity risk. So even if you're to live till 200, yeah, if it was a possibility, they should be able to pay you until that time. They have to ensure your income for life. And then for income drawdown, you bear the longevity risk with the potential to, you can actually outlive your funds with an income drawdown, because remember, it's dependent on the market. So you could, if you're putting a structure in place, you can do a combination of both, or you can take one over the other. If maybe you are a good investor, you're someone who knows your money well, and you're disciplined, you can do the income drawdown. If you feel like you're not as disciplined and you do not want to take the risk of the market, you can take an annuity. There's some people who know if they were to maybe put this money for their parents, they'll have access to it, and they don't want that, they can just put that money in annuity. It will be locked out there, right? So you see now, when it comes to the unfair advantage package, we have talked about the combination of the three: the protection against now the premature death, critical illness or disability, protection against outliving the income, and all these funds that are going to be collected here are going to go into this pot to ensure the distribution of wealth, right? So this, as I said, is a combination of the whole life cover, the pension, and the trust fund. So let's look at the unfair advantage package based on the examples that we've given of this client who's 30 years old. You see now, for them with 24,672, they're only paying that amount of money once every single month. They get a benefit of 10 million life cover, 5 million critical illness and accidental, 5 million as well, because you saw from the first example during the life insurance, their premium was coming to 6,698 every month, right? And they're contributing for 20 years. The monthly pension, they have to contribute when you're age of 30, if you want 300,000 per month, you have to contribute 12,974. And for the trust fund, to get the 4.9 million for the child, Tony, right, she has to put 5,000 aside every month for 20 years. So with this one, you can see that when Mary retires, she'll receive 300,000 monthly for life, because of how she structured her finances. She just needs to put the 24,000. And you see, even at year 20, the 24,000 will go lower to 12,974, because she would have stopped paying for the life insurance and should have stopped paying for the trust fund, unless she chooses to continue. But you see now, at year 20, she'll stop. So even the amount of money she'll be contributing towards her retirement moving forward from the age of 50 will be 12,974. Yeah. So you can see at the end of the day, Tony, the son, will receive 4.9 million to start his business or to go to school, whatever it is, at the age of 20, right? And then eventually, when Mary passes away, the descendants will receive the 10 million shillings cash, right? Because depending on how it is that she structured it, she could have put it now maybe made the trust fund the beneficiary, so it can be distributed according to the way it is she wants, right? But you can see now, as we have spoken and and now being able to reach the goal it is that you want. We want to ensure that no matter what happens, you never have to be a bother to your children by you planning your life right now. So we have to make sure that in the case something was to happen to you and your children are highly dependent on you, you have a life cover. In the case now you are to outlive your income, you have a pension plan. And in the case now you want now to ensure that there's proper distribution of this cash, we have the trust fund. So we've finished with that part. I don't know if there's any questions because I tried to rush through the pension, but in the case you need any more information, we'll share another more detailed video regarding this. It's just that I want us to now rush into now the trust setup because of time. I don't know if there's any questions so far.
So far none. Maybe we will answer them towards the very end.
Okay.
I'm just feeling personally, I don't know about the rest of the people, but I wish I was Tony at this point.
Yeah, right? Hey, what if you have done with 4.9 million?
An actual trust fund, baby. Huku nje, we are just funding ourselves. Imagine if someone just gave you 5 million today
Right?
at 30.
See,
Go
even
start your
me,
life. Oh
for
Lord.
me, I'll be so far. My God, like the things I could
It's
do with that money right now.
I know it's such a beauty to know we can do that for our children, honestly, even
Exactly.
if it was not done. So maybe we can continue at the very end, guys. We are going to have a live Q&A session. So any question that has been left unanswered will be tackled towards the very end. So and also please, I hope you guys are taking your coffee and your tea and your bathroom break. We've been here quite a while and we are still going to need a few more minutes. So in case you need a bit of a break, please take it. And then of course we can keep going. But Mnyindo, good job, keep going. We are just getting pressure and learning.
It's okay. It's okay. Even for me, now I need to be my own trust fund baby. I'm like, you know what? Maybe
Yeah.
I should open one for myself too. Yeah. But anyway, guys, in the case now you need any of these, we're going to share with you the forms to set it up. You can take them as individual, or if you want us to now help you set up a proper structure, you can give us your budget, or you can tell us what it is that you want to achieve, and then we can guide you on how exactly it is to set up. The beauty about it is that it's very flexible, and you can start with what it is that you have, and you can help you to put things in order of priority based on where it is that you are in life. Obviously, the person who has a 2-year-old is not the same as us planning for someone who has a 20-year-old and is about to retire. So it will be dependent on where it is that you're at in life. We'll be able to prioritize on your behalf, right? To help you prioritize. Because as we said at the very beginning, we want you to be in charge and to be the CFO of this, of your finances. So right now, I'll hand it over to Winnie to be able to take you through the trusts so that now you can understand now the full package, and we'll answer any other questions later. Thank you for that.
Okay.
Yeah.
Mnyindo, someone has actually privately texted me that we give them a 120-second bathroom break. So they're asking for a minute or two.
Okay,
So
no worries.
in the meantime, maybe we can just take a few questions that as we give people before Winnie begins. Someone is asking, do pension funds actually protect our money from inflation? Maybe you can address that because especially it is such a because it's such a long-term investment.
Yeah.
Please tell us if they earn interest and if we are being compensated for inflation.
So if you pick a good pension plan, because there's like literally, this is why these lists usually get released. There's pensions which give you from 4% to even as high as say 10, 11%. So obviously if the return on investment is below 6% for this specific pension, you are not being, taken care of. The inflation is not being taken care of. Yeah. So you have to make sure that you are picking a pension plan which has at least a return of over 6-7% to take care of inflation. So it depends, on which pension plan you pick, because some will not cater for inflation, others will.
Okay, that's really good. So it's so important for us to keep doing our due diligence.
Yeah.
Yeah, to confirm that.
The good thing with the pension, you can always like update it. You can always transfer and change it from one pension to another pension plan to another one at no cost. So it's good to now you'll stay up to date and say, okay, this one is not working for me, this one is working for me, and then you change. And I would advise everybody to have like their own individual pension plan, even if they have one at work, so that the time they are moving, they can be moving their their group pension to the individual pension. Because sometimes what we are seeing is people are leaving work and they're forgetting about the pension. So you're trying to look for your employer of 7 years ago. So it's good to be moving with your pension in real time. So
that is so true. And one of the things I also keep telling people as a financial planner is do not be emotionally attached to a particular company. I think one of the things, so many of us actually look at the interest rates, and then you can clearly see that your returns are so poor. Like you're literally getting 4%, 5%, but because I've been with this company for so long, or maybe my auntie, my uncle is the one who introduced me. We don't
yes,
want. I think I'm one of the success stories. You've moved me
I
from a
love
pension
that.
that was, yeah,
Yes,
you moved from a pension that was not
there's not,
giving me a very good return to one
imagine.
that, yeah, that one that is giving me a much better return. So that's so
Exactly.
important. And then the moving part Judith is asking, kindly elaborate. So like maybe for me, what I can say is that
Yes,
I was investing with a certain company X,
yes.
and when I was looking at my returns, they were not very good. So what I did is that I send in a request, not for me to receive my pension, because mine is a personal pension fund, but for that pension to be transferred to now the current pension plan that I have. So the first thing is to actually open that second pension that you would like the money to be moved to. So that's where you start. Once the account is open, it is active. Now you request your former pension company to transfer your pension funds from that company to the new one, and you give the bank details. So don't give your own personal bank details, because if money is being sent
Yes,
directly to you, they will tax that
yes,
money,
the
because
tax,
it's
yeah.
like because it's like you've received your good, your payment. All right. So it's also important. Highlander in the comment section has written a very, very important comment before we
Yes.
hand it over, before we hand over to Winnie, that I think is so important to reiterate. I'm just gonna read it out. She says, Highlander, please, hii jina yako hata tuelewi kama you're male or female. Please forgive us if we say he or she. Please let us know. But amesema, it seems to me that despite the need to have these covers and plans, sooner rather than later, it is more important to secure yourself first with an emergency fund and investments to avoid being unable to pay these plans or having them inaccessible, yet you are unable to meet your immediate needs. E.g., for non-parents whose siblings are dependent on them, needing to pay the niece or the nephew's school fees plus other needs, seem that they are in dire in comparison at the moment. And I really agree with you. What we are trying to do here today is to really give you all the options. We've been talking so much about the emergency funds. We've been talking about the money market funds. And yes, we are still reiterating that for the beginning, like if you're starting out and all of that, please ensure that you've put at least an emergency fund in place. You are doing proper budgeting. This unfair advantage package does not replace your budgeting. It doesn't replace your emergency fund. So I'm just agreeing with you, Highlander, truly, that pretty much it is so important to have these things in place first. The unfair advantage package is pretty much, and we said as we started, is that we want to change the narrative that we as Africans, we literally pass down poverty from one generation to another. We want to literally do away with that narrative and to ensure, again, as I said, like like Paul here in our example, this kid is just turning 20 something with like
With
5
cash.
million
Imagine,
being
yeah.
given. Yeah, and pretty much the goal is to give our dependents, our family, an unfair advantage such that they can start with a head start. When the people who are parents, if you pass on and you die, you're leaving your children with something that can benefit them literally within 7 days.
Yes.
So that's the direction we are trying to go. But guys, keep the questions
Yes,
coming. I'm
yes.
seeing some of us are back from our bathroom breaks. So I think, Nyindo, we can hand it over to Winnie to take us through the legal aspect of our discussion today.